Welcome to our deep dive on refinancing specialized education loans, such as those for professional training or flight school. First, we will set expectations. Refinancing can reduce interest and monthly payments, but it can also remove federal protections if you refinance federal loans into private loans. Next, we will explain when refinancing makes sense, how to compare offers using true APR, and how to choose between fixed and variable rates based on your risk tolerance and payoff speed. Finally, we will walk through shopping for rates, a step-by-step checklist, and 2 short quizzes to cement your understanding. Here is our agenda. First, why refinancing can help. Then, we will examine federal protections you could lose if you refinance federal loans. Next, we will compare fixed versus variable interest rates. After that, you will learn how to shop and compare offers using true APR. Then, we will review well-known lenders and the role of local credit unions. Next, we will cover an application checklist. Finally, we will test your understanding with 2 quick quizzes. Before we begin, a quick disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Your loans, employment certainty, and goals are unique. Therefore, you should consult a qualified advisor or a nonprofit student loan counselor before making decisions. Additionally, carefully review your promissory notes and any lender terms, as conditions and eligibility can change. To set the stage, refinancing can reduce your cost of borrowing and simplify your payments. However, it is a trade-off. The goal is to reduce the total cost while keeping the protections you need. If you have federal loans, converting them to private loans eliminates federal options. If you already have private loans, refinancing can still help by lowering your rate or shortening the term. Finally, remember that lenders often respond to competition, so use multiple offers to negotiate, particularly with local credit unions that may provide better terms than large financial institutions. This section highlights the protections that are lost when federal loans are refinanced into private loans. Federal programs include income-driven repayment options such as SAVE, public service loan forgiveness for qualifying employment and payments, and formal deferment and forbearance programs. Some federal plans offer interest subsidies and more robust discharge provisions. Once refinanced to private loans, these protections are not available, and you rely solely on the private lender's contractual terms. Therefore, if there is any possibility you will need income-driven repayment, PSLF, or flexible federal forbearance, reconsider refinancing federal loans. Proceed only if you are confident in a stable income and your near-term financial outlook. Now let's compare fixed and variable rates. Fixed rates provide stable, predictable payments and are suitable for borrowers seeking certainty, especially across longer repayment horizons or when interest rates could rise. Variable rates often start lower but can increase, making them suitable only if you can repay very quickly and you have high risk tolerance. If your income is uncertain or you need predictability, fixed is generally safer. This flowchart maps the key decision points. First, identify whether you hold federal loans. If so, assess whether you need income-driven repayment, PSLF, or federal forbearance provisions. If you do, stop and do not refinance. If you do not need them, evaluate your income stability and emergency fund. If either is lacking, pause and strengthen your financial base. If both are strong, pre-qualify with multiple lenders, including at least one local credit union. Next, compare the true APR across offers while ignoring teaser rates or sign-up bonuses. Evaluate fees, auto-pay discounts, and available term lengths. Finally, choose a fixed rate for predictability, or a variable rate, only if you will repay rapidly and the caps are acceptable. Then apply and set up auto-pay. When shopping for rates, gather at least 3 to 5 quotes, and be sure to include a local credit union, which may offer more competitive terms. Focus on the true APR rather than advertised interest rates or temporary incentives. Ask specifically about origination fees, late fees, and whether any prepayment penalties exist. Avoid lenders that penalize early repayment. Confirm whether pre-qualification involves a soft credit pull before consenting to any hard inquiry. Then, use competing offers to negotiate. Lenders can sometimes match or improve terms when presented with better quotes. This table provides a quick snapshot. SoFi is known for a digital experience and perks, but verify the final APR after any discounts and confirm there are no prepayment penalties. Earnest offers flexible terms and granular underwriting, which can benefit unique profiles. Ensure the auto-pay discount is reflected in the APR. Laurel Road often targets graduate or healthcare professionals with specialized perks. Again, verify fees and the total APR across the selected term. Local credit unions frequently offer strong APRs and personalized service, though membership eligibility and onboarding speed can vary. Always compare the true APR and read the full terms. This sequence diagram shows the refinance process. You begin by pre-qualifying with lenders, using a soft credit pull to view rate ranges and terms. If you proceed, you submit a full application and consent to a hard inquiry. The lender checks your credit, evaluates your file, and returns an approval with a finalized APR. After you accept the offer, the new lender initiates a payoff to your old servicer. The old servicer processes the payoff and closes out the balance, and the new servicer sets up your account and autopay. During the transition, continue making payments until you receive written confirmation that the old account is closed to avoid any missed payments. Follow this checklist. First, verify your loan types and avoid losing federal protections if you need them. Next, ensure your income is stable and that you have an emergency fund of 3 to 6 months. Then, pre-qualify with 3 to 5 lenders, including at least one local credit union, and collect true APRs in writing along with term lengths. Carefully review fees and confirm that there are no prepayment penalties. Choose a fixed rate for predictability, or a variable rate only if you will repay rapidly. Understand when a soft or hard pull will occur and how it impacts your credit. Set up autopay and calendar reminders. Continue paying the old servicer until you receive written confirmation of payoff. Finally, remember that you can revisit refinancing later if rates fall or your profile improves. Quiz time. Which single metric should you focus on when comparing refinancing offers across lenders? The options are true APR, advertised interest rate only, monthly payment only, and sign-up bonus size. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is true APR. Annual percentage rate incorporates the interest rate as well as certain fees and discounts, giving you a standardized basis for comparison across lenders. This helps you avoid being misled by teaser rates, temporary promotions, or differences in fee structures. Next quiz. When might a variable rate be a sensible choice? The options are if you can guarantee a rapid payoff and accept rate risk, if you want the lowest fixed payment over many years, if your income is uncertain and you need predictable payments, or if you expect federal loan forgiveness options. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that a variable rate may be sensible if you can guarantee a rapid payoff and accept the risk of rising rates. Variable rates often start lower but can increase, making them unsuitable for long-term repayment or for borrowers who need stable, predictable payments. Here are the key rules. First, refinancing federal loans eliminates federal protections such as income-driven repayment and PSLF. Second, use fixed rates for predictability and variable rates only when you plan an aggressive, short-term payoff. Third, always compare the true APR and ignore promotional headlines or bonuses. Finally, include local credit unions in your quote set, as they frequently offer better terms than large institutions. To conclude, refinancing can be powerful if you do not need federal benefits. Always compare offers using the true APR and verify fees and term lengths. Prefer fixed rates unless you can repay very quickly and are comfortable with the risks of variable rates. Shop widely, include credit unions, and negotiate using competing offers. Finally, time your payoff handoff carefully and continue paying until the old servicer confirms the account is closed. Thank you for watching. If you found this helpful, please like, share, and subscribe to support the channel. We would love to hear your refinancing questions and experiences in the comments, so share your thoughts and we will respond.